Hello, it's Chew Dog Charts, and the general consensus is that the bear market of 2018 is now over. Early February, we had the correction of 10 to 12%, and now we're having a comeback. Not real strong, but the stock market is climbing once again. And with that, one important question has been answered. And the question is, when are the central banks going to step into the market? How much pain are they going to allow? Well, we know that they stepped in, and we know that the market corrected from around 10 to 12%. So everybody, just stay calm, take a deep breath, and relax. So now the next question is, where do we go from here? Well, let's take a look. This chart here is the SPY, the spiders, and it goes back to early 2014. And although the consensus is that the bear market of 2018 is now over, we have some important points that we need to keep our eyes on. Number one, despite the correction, the market did hold support at the 200 DMA. And here in the chart, you can see the 200 DMA right here, going all the way back here. And then the portion here in the right margin, that is the zoom in of last couple of weeks, the trading of the last couple of weeks. So we've held the 200 DMA, and that's one important point. And number two, the bullish trend line, which is this bold or larger bold red line going back to early 2016, it has also not been violated. So that's good too. And then number three is this line here. This is the upper trend line. Now that upper trend line is going to provide some overhead resistance temporarily, and we're going to keep an eye on that. And this resistance is right here, and you can see that over here too. And if you remember one of my videos last week, I told you that we're going to have a stall at this point here, and that's where we are. We're not sure if we're breaking out and above yet, or if we're going to come down and form a W type formation, but we're just going to have to keep watching that closely. And then number four, while the market did get oversold, at least on the short-term basis, and that did suggest a bounce was likely, the longer-term overbought condition and some sell signals still remain intact. So the market has not violated any important trend lines that would suggest that the current sell-off is just an ordinary garden variety correction, but we need to keep our eye on things and watch what goes here in the near future. All right, let's go to the next chart. And this chart here from Real Investment Advice shows the comparison of the three stock market periods, beginning here with the S&P 500, the time frame from 2004 to 2008, this shown right here, and this was the result of the great financial crisis all the way through down to here, down to this point. And the second time period, going back a bit further, was from 1996 to the year 2000, and that is shown here in the lighter color blue, and this was the dot-com bubble. And then, of course, the current time frame, the S&P 500 from 2014 to the present time, and that is shown here in the red with the peak at that point, the correction, and then the bounce back. And on the bottom of the chart are the number of trading days, and each of these three time periods have been tied back here to the 0 point. So the good news for those who remain bullish is on a long-term basis, the bull market remains intact for now. Unfortunately, despite the correction that we had recently, little was done to relieve any of the underlying pressures. And those underlying pressures include the fact that valuations still remain at very high levels. Number two, the bearishness and the volatility, despite the recent spikes in both of those indications generally remain at significantly low levels. And then following the correction, investors simply couldn't jump back into the market fast enough. And we had, of course, the backing from the central bankers who apparently don't want to see any more pain than a 10 to 12% correction in the market. Now, looking at this chart here and simply looking at those time frames and the prices without the full context can be somewhat misleading. I don't want to do that. So while markets are driven in the short term by momentum or perhaps psychology, it's the long-term underlying fundamentals which ultimately determine a market's fate, and we want to keep that in mind. So let's go to the next chart. And this chart here, also from Real Investment Advice, is interesting, showing the market flashes long-term signal as the measurements align. And I'll show you here in the upper portion is the chart going back to 1904, and you can see the different time frames, such as the panic of 1907 here, the crash of 1929, and then into the echo crash, the end of World War II, back up here to the crash of 1974, and then the 1987 crash, followed by the dot-com crash, the financial crisis, and then, of course, the current time frame. Now, you take these vertical lines and you go down here, and first off, we have the CAPE ratio, and the CAPE ratio is shown in orange here, and it's overlain here with the S&P 500 in the dark blue. Going further down here is the RSI, and the RSI is also in orange when it's above 70, and that's showing a very elevated level in the RSI, not quite to the overbought level, but anything over 70 is toward the upper end. And of course, below 30 is in green, and you can see there's not much green here. Again, the overlay of the S&P 500 here. And then you follow the vertical line down below, and you can see the deviation of the S&P above and below the mean average here. And it's spent quite a time below, but then it's also spent plenty of time here above. All right, so you take each of these individual vertical lines, and you can follow them up all the way up through each of these three indications and into the time frame here, say 1987. And then the dot-com crash is here. Following that vertical line up and down, you can see the different indices and their particular signals in the current time frame going on up into here, and that's where we are right now. So on virtually every measure, price and valuation, the market still remains very overvalued or extended. So it's when these measures coincide with the onset of an economic recession, and that's going to be what will cause a mean reversion or mean reverting. Essentially, the S&P 500 falling back to its mean. So let's go to the next chart. And so the next question is, what's going to cause the next crash? And we've talked about this quite a bit. Nobody really knows for certain, and I think you know my opinion that it's most likely going to be something credit related caused by the Fed's misguided policy of hiking interest rates and tightening monetary policy. As you can see here in this chart, this is the total system leverage, and you can see the total system leverage in the chart is red, and the S&P 500 is in blue. And going back to 1966, it's not perfect, but there's a pretty good correlation between those two lines. And so what's going to happen is once the Fed starts tightening even more and hiking those interest rates, the resulting loss of wealth effect that you and I feel, that's going to weigh on the consumer, on the consumption, and that's going to push the economy into recession, which then is going to impact the corporate and household debts, leading to lots of defaults and write-offs and bankruptcies. And as I showed you in a recent video, if you saw it, if you did your homework and watched that video, you would know that the big banks are showing a slight tick off in the net charge-offs. But Where it's showing up now is in those smaller banks. And those smaller banks, their net charge-offs, if you recall, are at the crisis levels now. So let's go to our next chart. And so the last question is, when are we going to have an economic recession, and when may that cause a mean reversion in the stock market, or in other words, a correction or a crash? And this chart here from Real Investment Advice shows the Fed and 10-year interest rates versus the real economic growth. And here in the darker shade, not much darker, you can see that this is the Fed rate hike period. And here are the Fed rates here, showing the last few rate hikes here. Now, if you go back into history, you can see that those Fed rate hike periods are followed very closely by a recession. And each and every case, the rate hikes were followed by a recession. The rate hike periods may last shorter or longer, but in each and every case, it was followed by a recession. And if you remember, just 2 charts ago, when I was talking about those vertical lines and those measures coinciding with the onset of an economic recession, often, if not always, that will cause a mean reversion of the stock market. This chart doesn't give us the answer of exactly when we may have a correction in the stock market, but it gives us a pretty good idea that the mean reversion of the stock market can't be long from now. So for today, that's Chew Dog Charts. Thank you.